if I do invest my money in Africa, will I get it back? What sort of returns will I attain? And we looked to answer that question in this study. We looked specifically at how PE firms created value. So we looked at, through in-depth interviews with the fund managers, how they sourced the deals, how they looked to create value during ownership of these deals, and finally, how they looked to exit. We identified over 118 exits from publicly available data, a lot more than a lot of private equity professionals thought there would be in the market. And we got in-depth interviews with 69 of this in our sample size. So as a bit of background, EY has done this study in North America and Europe for over 7 years. They've done it in LATAM for 2, and the first one was released earlier this year in April. So I will initially just talk, the graph on the left shows you the exit route by exit year as a sample of our population. And what you see is that the sell into trade buyers has been the most significant route, over 50% on average looking across those years. And this has been, just talking about the breakdown, this has been to 3 types of trade buyers, what we call trade buyers and strategics. So there's been to the local, there's also been to the regional, and to the multinationals coming into Africa. And we think that trend will continue to be strong as we've launched the second part of this study this year. It will be an annual study, and we think this trend will continue. And we've also seen if you look at sales to PE, it's grown from 12% in 2007 to 23% in 2012. And we expect this trend to continue as the market looks to mature and there are more fund managers raising consecutive funds. We expect that trend to continue in the market. And just to answer the question that we hear from a lot of people about deals failing, if you look in 2008, 2009, there are very little deals, less than, on average, less than 5% of the deals that have happened in Africa in that time have actually failed. So this is to show that private equity fund managers are very smart, innovative, and look for ways to ensure that there's not just value creation, but you retain value during the time of that investment. On the right, you just look at the distribution of exits in Africa across that time frame, and as you can see, it's been, I'd say, fairly constant, maybe apart from in 2009 when that value dropped. And that could, there are different reasons for that. That could be due to the credit crisis. People were looking to hold on to some investments just to see them through that period. But it's really been fairly consistent. And in 2013, we're looking to backfill that data, and those numbers will increase. Already we covered 118 in the first year, but that number is already reaching 200 plus at the moment. Okay. Now this graph will look to tackle the question of distribution. A lot of people would expect that the exits would only be in South Africa. And this shows that majority of them are in South Africa. But there is good variation across the rest of the regions as well. And if you look at it, it's there. Obviously, the countries you would expect, South Africa, Nigeria, Ghana, Egypt, are the key markets where you see these exits, and making up 74% of it. But when you look at the country distribution, these exits across all regions probably happen across 20 different countries. I expect that number to grow. So it's encouraging to show that even if you invest somewhere that you consider a frontier market, that you are able to get an exit. And looking at the exit by sectors, we should realize that this is looking historically, so 2007, 2012. Some of these investments would have been done early 2000s, late 99. But a key trend that you see here is the financial sector. And it's interesting to see, I was noting there's some correlation with the data Rory's found about entries. The financial sectors have been a big play in Africa, continue to be a play in Africa. But you also see the food and beverage industry come, and what is key here when you put different sectors together is you begin to realize that Africa is really a consumer story. The growth of the consumers, the emergence of the middle class, and it's really, proves wrong the perception that it's really a resource and commodities driven industry. There is a lot of play and access to that, and private equity gives you a lot of access to that particular diversification of your portfolio. So at this point, I will let Dorothy continue.
Hopefully the technology will work. Oh, that's it. Just in terms of size of deals, we looked at the entry enterprise value, and we expected to find mostly small transactions, as is the stereotype of Africa, or was. We actually found that a third of deals were 50 million plus entry enterprise value, and the rest were equally split at the smaller end of the transaction deal size spectrum. Now, obviously, we define a private equity firm quite strictly. It has to have raised third-party funds or be a captive within a recognized bank. So we don't consider some of these quasi-private equity firms that are sort of raising their own money and putting it into transactions. So these are professional private equity firms' investments. So this was quite a good story for Africa, again, proving that deals are not just very small. To be fair, a lot of some of the 50 million plus deals were pipes because they were fashionable at some stage. So private investment in public equities, they do account for some of those deals in the 50 million plus. But again, that's historical. And going forward, we do expect this picture to remain roughly the same. Now, to the meat of the findings, we found a number of things, and we've sort of boiled it down to 5 key ones for the purposes of this presentation. The first one is that private equity outperformed public markets. And this public markets, in this sense, we did take the Johannesburg Stock Exchange as the kind of benchmark stock exchange for Africa. Private equity provided 1.9 times relative return to the Johannesburg Stock Exchange. So this was a great finding again for the study because we've shown that there are exits in Africa. They're not as risky as we thought because not so many creditor exits as people thought, and you can also make money. So this was relative to public markets. So again, great finding for private equity investments in Africa and should help dispel some of the reservations that limited partners have in investing in Africa. And then in terms of creating value in investments, we found that private equity firms are really effective at leveraging their networks during the ownership period of the company to bring value to the firm. So you're thinking of some of these entrepreneurs or small-scale business owners. They don't have the extensive networks that private equity firms do. And private equity firms here are helping to identify potential acquisition targets or dealing with regulatory bodies in different countries, finding board members. So again, this is actually quite a key best practice where you own a portfolio companies to bring the full spectrum of your networks to bear in managing the company. And companies that did that posted 2.4 times relative return over companies that didn't. So key value add there. The next one that we found that we weren't expecting to was improvements in environmental, social, and corporate governance policies of firms. Now it's true that private equity firms do improve governance generally in terms of improving management, reporting, etc. But we found PE firms were going over, sort of the bounds of duty and making sure there was compliance with, things like bribery, etc. And this was helping to dispel against some of the myths that, there's corruption in Africa. Now, we found in 85% of cases there were significant or certainly effective governance changes, and those that did do that posted more returns, 1.9 times. Some of the 15% where there was limited governance, they were listed companies. So if you think of some of the pipes, there's a limit to what the private equity firm would have done in terms of improving governance. And then again, for some of them, it was clear that the company was going to fail, so the PE firm didn't even bother to make significant governance changes. Occasionally, it's where the PE firm didn't have boots on the ground, so they didn't have a local office. It actually goes to Jean-Marc's point earlier about when they do get Lagos office, they'll start doing deals there. Occasionally, it was where the PE firm didn't have boots on the ground, couldn't observe very closely what the portfolio company was doing, that there were significant governance or disparities between what they would have hoped for and what actually happened. And another value add was, for Africa, it's all about partnering with the entrepreneur and management team. It's not like the West where it's kind of leverage, buyout, hands off. So the sort of cross-fertilization of ideas, and it's largely because it's minority stakes and you can't really just sack the entrepreneur. But PE firms are very much, hand in hand, getting down, helping to manage a portfolio company, spending a lot of time, actually. It'd be quite interesting if some PE firms start to quantify the amount of time they spent with portfolio companies. It'd be quite interesting to see what those numbers are. But where they did, and where they backed the incumbent management team, there was a slight outperformance relative to where they didn't, or a new management team was brought in. In Africa, obviously, there is an issue with scarcity of talent. There isn't a huge pool of experienced management teams to pull on. Hopefully that'll change in future, as companies scale up and people return back to the continent. And then a final finding that we found out was that what private equity firms are doing actually is helping the Pan-African development of the continent. So back to the trade buyers point, 50% went to trade buyers, but these weren't just multinationals. A third were African trade buyers, so like a South African trade buyer buying in Nigeria, for example. So a lot of these transactions are being sold to African trade buyers and helping just to develop across borders and helping the pan-regional development of the companies. For the larger portfolio companies, PE firms are also just helping to expand them regionally across, I suppose, countries. And then finally, we found that there were certain exit enablers. So PE firms are doing this in some respect, but certain things also helped increase value on exit. One of them was ensuring the continuity of management teams at exit. So this is not just when you're buying in and making sure they're staying for you. When you're leaving was also to make sure that private equity, that the buyers got confidence that the management team would stay. So sometimes they were being given golden handcuffs of, say, 3 years to hang on with the next buyer. And those that could do that saw a relative uplift in returns. Another one was to start exit preparation early. It wasn't just to wait to kind of 6 months before you thought you might exit and then kind of just rush to get everything done. So 2 years, 18 months before exit, sit down with the management team, plan the market positioning of the company, and get the detailed planning going. Those that did do that did surprisingly, or not unsurprisingly, actually very well. And the third, again, emphasize the point, networks, networks, networks. In Africa, it's all about networks. So a lot of people are leveraging their networks, finding exit partners almost at the point of entry on behalf of the portfolio company. And that is the end of the key findings.